Good morning, everyone, and welcome to March's monthly session. Timmy the Great, I saw you waving at me. I thought we might have some technical difficulties. Hopefully, everyone can hear me pretty well. Thank you all for joining. Those people watching later on video. For anybody who is new today, I want to introduce myself. I am Paul Nalabondian, your local market expert and host for these monthly sessions where we cover all of the key developments in the real estate market and the economy, which impacts the real estate market, and then obviously mortgage rates. So I'm an attorney licensed in the District of Columbia, also a top producing realtor licensed in Virginia, Maryland, and DC. I'm a team leader with Fulcrum Residential, as is my wonderful colleague, Timmy Koji. Fulcrum Residential, we are a top nationally ranked real estate team, and we are proudly affiliated with Keller Williams Capital Properties. Temi on the ones and twos, my wonderful colleague who is moderating the chat. Never one for long introductions, but would you like to say hello to the folks and introduce yourself, Temi?
Hello.
There we go. As succinct as always. I mentioned this in the chat. Let me pop over to take a quick look, see what we have in there. Everybody who is on this morning, if you can let us know, if you want, if you don't, if you want to stay anonymous, that's totally fine. But whoever's on right now or watching later on YouTube, if you want to mention where you are from, if you're an agent or an industry professional, which areas you cover, if you're a consumer, whether you're a buyer or seller, investor, or just might be at some point, and why you joined today, what you're interested in, what you would like us to cover. All right, Montgomery County being Kennedy. Yeah, we're definitely going to cover Montgomery County. A lot of interesting stuff happening there. Okay, we are going to follow our typical traditional format, a little bit different today, this month, just because we have the conflict in Iran, which is affecting a lot of things and could dramatically affect a lot of things. So we're going to hit on that. But we are going to start off with mortgage rates and economic data. We are going to look at mortgage rates, where they are, where they've been, where they are likely headed. Then we're going to go into the economy because that impacts mortgage rates. We are also, like I said, going to touch on the conflict in Iran, the implications. Then we're going to take a quick peek at the DMV economy before we transition into real estate specific. We're going to spend at least half of the time just focusing on core real estate in the DMV. We're going to look at the most recently reported month from Bright, which is February. And then we're also going to look at the first 2 weeks of March and take a quick peek to the future as well. All right, let's get started. So mortgage rates, where are we at? I would love to see, so I can tell you what's being reported. I can tell you what my clients are getting, but love to have just more reps, more examples. So anyone on here, if you are an agent, if you could please let us know if you have had a client who's locked a mortgage rate within the past week. You could let us know what the rate is and whether it's fee simple. Wonderful to have you on here. Virginia, our principal broker, and has an MBA in econ. So her insight is particularly valuable here. Always great to have you with us. But yeah, so I'd like to hear real world links. I don't know if we have Mark Linkowitz, our lender partner with Envoy Mortgage, on here. If you are here, Mark,
He's
if
on.
you could, nice. If you could chime in. So Tom is saying he's getting 6.4 from Mark, and that's what, like, that's kind of anybody who was locked very recently. That is kind of what I'm expecting. And you can see here, this is the lately I've just been throwing up a graph from November until now to give you an idea of where we've been dropping to. You can see the most recent spike. And then I want to add a visual just to highlight what the conflict with Iran has done to mortgage rates. You can see that line there right in the middle. That line is from February 27th. The coordinated strike began on the 28th. Rates aren't reported from Mortgage News Daily or a lot of the entities over the weekend. The next rates are reported on Monday, and you can see it's been a big jump since then. So everything is up. It had gone as high as low 6.4s. Now we're kind of dropping down to the 6.3s, and this is just what's being reported by the various entities. Your clients' numbers may differ. And then this, so this is still true. And the reason I plug this in, even though rates have gone up, they are still within this roughly 6 to 6.3 band. And I've been talking about this for the last couple of months now, that we are in this 6 to 6.3 band, and we have been for the longest time since rates jumped in 2022. So even though, I mean, it kind of hurts a little when you see, you go back to, let me go back, you see, when you see fives, like people's eyes start to light up. Back in the days of 2% mortgage rates and 3% mortgage rates, never thought I would see people so excited to see a mortgage rate starting with a five, but it's kind of a big deal. And you start to hear a lot of chatter when that number starts with a five, and it was just there for a oh so short of a time. But even though we've gone up, we're still, like I said, in this low band for the longest time we have been since rates increased in 2022. So if you're a buyer or you're counseling buyers out there, just let them know right now is still a really good time to buy relative to where we've been for the last few years. That could be changing dramatically. We're going to talk about that in more detail. Jumping into the specific products, and like I said, if this session would have been held on February 27th, we would have been having a much different conversation about mortgage rates. But as they stand now, kind of everything up, the 15, 30-year and jumbo are up about 30 bips over where they were when we met last month. ARM is up more, about 40 bips. VA and FHA up around 24 bips. And speaking of the conflict and kind of in general, how are people feeling about the economy? What are your clients saying? What are their concerns? Uh, while people are dropping, hopefully, some comments in the chat, I'm not going to go into this in a ton of detail because I do it every month. So if you're new on here right now or watching this later, just go back to one of my prior sessions. I label them all. Just look into the chapters under why I talk about the economy, and I'll go into more detail. So going to be a little more brief today, but in short, I talk about the economy and the Federal Reserve and trade policy and all of that because that's what impacts the bond market. And most mortgages are packaged into mortgage-backed securities where they're sold in the bond market, and they have to compete with other products, other debt-backed instruments. And so they have to be a competitive product. When more money is going into the bond market, when there's more demand for these types of securities, you can offer a lower mortgage rate and a lower yield on these bonds in order to make them attractive. So right now, and I'll talk about this in just a minute, but it's interesting. Usually when there's economic uncertainty, people flood into the bond market. So typically when there's economic uncertainty, you would expect mortgage rates to drop. Unfortunately, right now, a lot of the economic uncertainty is surrounded or is driven by a spike in oil prices, and that's going to lead to inflation. And when you have inflation, it's, bonds have a set rate of return. Higher inflation is, the more it eats into that return, less appealing it makes that product. So the inflationary pressure is causing bonds to be less appealing, or at least less appealing at the same rate. So rates have to go up. Temmie, so disappointed. I depend on you for many, many things. One of them is my reminder to
Your
go.
coffee.
Yes, coffee of the day. Oh, and then
You
that's
said you said Iran, and I just
I
completely.
well, no, I know, and there's so much. Each month, I'll kind of send out a text to like Fulcrum peeps and other agents, and I'll say, "Hey, my session's coming up. Join me." And every month for the past, I don't know how many months, I'll say something like, "There is a lot to talk about today," and that's been the case. It blows my mind really that there's so many things happening, kind of very unusual or unprecedented, that it's just like every single month there is just this whole new can of worms impacting the economy and the real estate market. We have so much to cover. So I got a little ahead of myself, got jamming in, but okay, we are going to dun, dun, dun. All right. Our coffee of the day is from Shoebox Coffee in Chicago. And so Shoebox, if you love coffee, if you happen to be in Chicago, or they mail around the country, around the world, if you like good coffee, Shoebox is an incredible roaster. I've had a handful of beans from them. This one is particularly interesting. I wanted to share this with you all. It is a mystery coffee. There is a thing called the Mystery Coffee League, this kind of organization, contest, just fun little thing to do pass the time when you enjoy coffee. But a different roaster each month will release a mystery coffee. And if you choose to get it, you get the beans, you brew, delicious little cup here. You brew it up as many times as you can, as many ways as you can, and then you try to guess what it is. You submit your guess, and the person who comes closest, or the people who come closest to guessing what it is, win some prizes. So I'm not really in it for the prizes. It's just kind of fun little community, people guessing. This one is delicious. If anyone is interested, hopefully we have no one else here who is on the Mystery Coffee League. I think this is a pink bourbon from Colombia. My guess is you also have to guess the altitude. I would put altitude in the block of 1,500 to 2,000 meters above sea level. More specifically, I would guess 1,750, because to me, this tastes like a washed either anaerobic carbonic maceration or yeast inoculated pink bourbon from Sebastian Ramirez, one of the top producers in Colombia. All right. I love the eye roll. Thank you for your support, as always, Temmie the Great.
You're such a coffee connoisseur.
It's just wonderful. Like when you think of things like this, like wonderful, I love steak. Can't eat steak every day, not necessarily the healthiest thing. Or wine. There are all these things that tend not to be healthy to have on a regular basis, whereas coffee has actually been shown to help. It lowers the risk of dementia, helps with weight loss, all sorts of things. So it's like really in proper volume and moderation. It's just a wonderful, healthy hobby. And I just want to note that compared to pretty much anything else like it, the costs are very reasonable. Like you think if anybody who's into steak or like high level A5 Wagyu or incredible wine, Bordeaux, Burgundies, or just like high level whiskeys, even bourbon has gotten crazy expensive. Whereas you can have some of the top coffees in the world, brew them at home for $5-10 a cup if you want to get like crazy level elite. Whereas a corresponding thing for another similar hobby would be much more expensive. Okay, we are risking going off the rails here. We're going to jump back. Temmie, I'm going to blame this on you as the moderator. It's your job to stop me from going down the rabbit hole. Okay, back to the economy. And we have an embarrassment of riches here. An embarrassment of riches with the information we have this month. For those of you who have been with me for a little while, you know that there is a little bit of lack of information with the government shutdown, the head of the BLS, Bureau of Labor Statistics, being fired, and I had the gone fishing graphics up here, just didn't have a lot of data. Between when we met last month and today, we got not one, but two releases of GDP estimates for Q4 2025. We got not only the advance estimate, which came in estimating Q4 at 1.4, but then we got the second estimate, which came in at a revised, you can see it here, a revised 0.7%. And now the last couple of times we met, the Atlanta GDP Now model had been, what was it? 2 months ago, it was up 5.4%. They projected a 5.4% increase in Q4 GDP. When we met last month, it was 3.6. And I don't want to say, I was kind of like shouting from the rooftops that these numbers made no sense to me. Like they made absolutely no sense. Everything I'm seeing didn't add up to a GDP number like that. And so I don't want to say I told you so, but I did tell you so. If you've been following along, like I've just been railing at like these things aren't just making sense. And I don't know how economic projections are putting out these numbers when there didn't seem to be a lot of basis in the underlying data. And now I feel a little bit redeemed. So thank you very much, official GDP numbers. You can see that is a much softer quarter for Q4. All right, now moving on, Atlanta GDP Now, they're projecting Q1 2026 GDP coming in at 2.7. And right now you can see that the blue chip consensus band, they're actually kind of in the middle of it. Usually they're at the high end. They're a little bit lower right now. Okay. This, we might spend 3 to 5 minutes on this, but honestly, this is the most important thing right now that will be impacting us as agents or you as consumers. And it's not even close. Like it is not even close. This has the potential to disrupt and change everything. And I don't think that is going to happen. But really quickly, I just want to run through why. All right. Already, we have seen a bump in oil prices, a dramatic bump. Prior to, if you look at February 27, U.S. supply, if you're domestic and you want to buy barrels of crude, it was like in the 60s. It's now up into almost $100 a barrel. So you've seen a 30 something percent increase. Globally, there where demand is more constrained. So the US right now has an oil surplus. Like we're energy independent. We don't need to get oil from the rest of the world. But for the rest of the world, you're running into more of a shortage, and barrels of oil went from, I think they were $70 a barrel right before this happened, to they're up 115. And this is like fluctuating all the time. You might be seeing information in the news like these prices are just all over the place. I'm going to pull up the uh, global oil. Just one second. Come on here. Okay. So, okay, 113. This is the Brent crude oil continuous contract. That's a good metric to follow. So 113, right before this conflict, it was $70 a barrel. Like, why is that important? So many reasons. Higher oil prices equal higher gas prices, which increases the cost of goods and services for anything requiring transportation. And almost everything requires transportation. So this is just direct lever into higher inflation. And then high inflation means whenever you have higher inflation, the treasury yields rates go up. So you're going to have higher treasury, you're going to have higher mortgage rates. Then you're also going to have more stress to the economy, which increases the risk of recession. And and so like none of this is good. So if the conflict is prolonged, the likely impact is stagflation. So you have an economic slowdown, an economic stagnation, but then you also have inflation. That's the absolute worst of all worlds. So if this continues the way it's going, it's likely to be stagflation and a recession. If it's really prolonged, worst case impact is like catastrophic to the global economy, like global recession. And it's not just recession, it's like, so the Strait of Hormuz, which is locked down by Iran right now, handles roughly 25% of the world's oil, but they also handle food for the region. So you're going to start having a lot of problems with getting sufficient food into the area. And then beyond that, it handles a major, and this is, I know this is going to sound ridiculous, like, why are you talking about this? It handles a major portion of the world's agricultural fertilizer. But that's important because if you're having trouble shipping fertilizer, that means fertilizer costs skyrocket. Like, I don't know if anybody on here is a farmer in the United States, but if you are, you know that your margins are razor thin and you cannot afford increased costs on anything. So it's like when you think about conflict in Iran, maybe the last thing you're thinking about is how it's going to put a squeeze to American farmers, but it is. And so that's just one of the many things. And okay, I know I said I'm only going to put a couple of minutes on this, but I just have to add one more thing. I try to keep this apolitical because I just want to cover the data and I just want to provide useful information that is relevant to everyone. And I don't want to come with any particular bias. And I feel like I do a fairly good job with that. I talk about a variety of things where it's just even handed what I see the data telling me. There have been heard a lot of people talking about how the current administration was causing people a flood of homes to come on the market and fire sales and people flooding the area. And I repeatedly hit back against that, saying that is not the case. The data is not showing that. We've been seeing higher inventory prior to the current administration, and we're not seeing a massive flood. So I always try to present things rationally, even-handedly, and not with the political slant. And so I say these things in that same vein because I'm just talking about what the data is supporting. But sometimes I feel like the current administration is intentionally trying to tank the economy. Like every major action they are taking is harming the economy, and it's crazy because obviously the stated intention is not to do so. But and I'll speed this up before and then move on. But like tariffs. So tariffs increased domestic manufacturing costs because they increased everything in the input chain, everything in the supply chain. So they increased manufacturing costs. They decreased domestic manufacturing because of the increased costs. And most estimates have, as a result of the tariffs, we have lost 100,000 manufacturing jobs domestically. Then you have Doge coming in, and they weaken the job market by creating much higher levels of unemployment. Typically, the federal government is when I talked about healthcare providing a lot of jobs. It's like healthcare and the federal government really steady the job market most years. That is no longer the case. So they've dramatically weakened the job market. And then, despite the Doge talk of reducing governmental expenditures, that hasn't been the case. Governmental expenditures are ratcheting up dramatically. The big, beautiful bill comes with a big, beautiful bill. It's very expensive, trillions of dollars adding to the deficit. And when you have an increasing federal government deficit, it does a variety of things. But one of those is it's also pushing up Treasury yields, and it's increasing the cost of borrowing. And increasing the cost of borrowing leads to inflation, and it leads to everything being more expensive. It also leads to lower business investment because businesses have less money or are less able, or it's more expensive for them to acquire capital in order to invest. When you have lower business investment, you have higher unemployment. And then now you have the Iran conflict. Like, if you ask me what would be the easiest and quickest way to destroy the world economy, and I would say shut down the Strait of Hormuz and choke off 25% of the world's oil supply. Now, let me put a cherry on top of this, or a silver lining. For what it's worth, and this is just my general opinion, like, the stakes are too high. I don't think the administration can stomach oil being cut off and us being pushed into a global economic recession. So this is just my opinion. But if Iran doesn't back down, if they don't open the strait back up, right now there's a Marine Expeditionary Unit that's en route to the theater. I think they're going to be there sometime within the next 3 to 7 days. And I believe they'll take Karj Island. I think we will literally occupy Karj Island, which is where most of the oil goes out of Iran. And that would be a massive, massive pressure point in order to get this thing resolved. So I think most likely this isn't going to continue like this. We're going to see some short-term impacts, some lingering impacts, but it's not going to have dramatic changes to the economy and the real estate market going forward. But that's only if the strait gets opened back up. Okay. And so I covered that because I think it's super relevant and can have a massive impact. But I always love to hear what people think and whether what I'm spending time on is helpful. So please drop in the comments if you think that was too long, too much of a rant, not necessarily useful to real estate, or so on. I love constructive feedback. Okay, so how are people feeling about? Oh, go ahead.
I think it was useful. I think before I saw the Goldman Sachs report last week, I think I was really stressed out about the whole Iran thing. But now I'm I know that I think that they did a really good job of going back in history and like showing us like where we've had something with Iran almost every single president. But I think the accumulation of everything since in the last 2 years has kind of made it feel a lot worse. But I also think that just even hearing about the fact that because I like historical data to kind of help calm like current data, but also looking back and seeing the fact that we were reliant on oil for a very, very long time. And so I think the US now uses 70% less oil than we did from back where the Reagan administration, when we started, a lot of the stuff with Iran. So like we've used so much less oil, but it still impacts us in such a great way. But just learning about the history helped me kind of calm down because I was a little bit panicked as a real estate agent. But going back and just learning like the history of our conflict with Iran and like where we are now, I'm like, oh, okay, this is to me a little bit. This is kind of what happens almost every few years.
Fair points. And if you're feeling good, I don't want to ruin that. But in my humble opinion, this is different from any of the past conflicts. And so I think the 70% number is we used to be much more reliant on foreign oil. Now we are much less reliant on foreign oil. But the rest of the world isn't necessarily. And domestic oil, like I said, the price of domestic oil has already increased by 35%. So even though, like I said, we have an oil surplus, we're not relying on imports of that, it has still caused the price of oil to skyrocket. And so also it's like there are multiple red lines here, and I don't want to turn this into a thing about the Iran conflict, but general consensus thoughts were Iran's not going to shut down the Strait of Hormuz because they need it too. It's like basically like glass house throwing stones, and then they're not going to attack their Gulf neighbors because they need them for a variety of reasons. And right now they've been pushed into such a corner. It's almost like this is an existential threat to our existence. If we're going to be wiped out, then it doesn't matter what we do. They have crossed so many red lines, done so many things that people thought were previously unthinkable. This is absolutely very different. And if it continues and the oil is choked off, like these things will happen. Basically every other major spike in oil prices in our lifetimes has caused a global recession. So it's just dramatic, and it's possible this whole thing could be wound down, but if it's not, and the strait continues to be shut down, like this is absolutely going to happen. There's just no way around it. Okay, jumping on, how do people feel about the economy? They feel bad. The conference board's consumer index, it inched up in February, so it reported people feeling a little bit better, but it was right before the Iran conflict started. Michigan Consumer Sentiment Survey dropped to the lowest number of the year. And it was really interesting because the survey period for Michigan was like half of the survey period was before the conflict started. Half of the period was after the conflict started. Before the conflict started, their survey would have reported an increase in consumer sentiment, people feeling better about the economy. After it started, people were feeling so much worse. It wiped out the gains from before and went down overall. This is something that I've covered in the past, but it's super important. So just wanted to leave the slide up in here for people who haven't seen it before. It's like, why, even though the GDP projections and numbers are coming down, they're still positive, still indicating a fairly robust economy. So many people, though, are feeling like, wow, I'm hurting. I don't have a job. I've been looking for a job for a year or two, can't find a job, or I'm in a job that I don't like, but I can't get another one. Or like budget's really thin. We're making the same amount of money, but everything is more expensive. And, if you're wondering like, why am I feeling like this when what I read in the paper or online is so good? And it's just because there's a disconnect. The economy is very uneven. You have some major states pushing up things for everybody. 22 states in the District of Columbia are likely already in a recession. You have a massive AI buildup that is driving GDP, but that doesn't cover anyone. And then the affluent are doing very well. Top 10% account for 50% of consumer spending. Consumer spending accounts for 70% of GDP. Okay, this also hasn't been updated. There haven't been updated unemployment numbers for the DC area. So the latest stuff is still from December. But just in short, the DMV as a whole has a higher unemployment rate than the nation. Out of that, subset of DC has an even higher unemployment rate than the overall DMV. And Virginia has a lower unemployment rate than the area, also has a lower unemployment rate than the nation, but their unemployment is about 50% higher than it was last year. And then you can kind of see this is new administration came in. We were right in track with the national unemployment rate. And then with all the government layoffs, our unemployment rates have shot up since then. Consumer price index. This is also going to be quick because this, I'll tell you in a second. So 1 month change, prices went up 0.3%, largely driven by increases in shelter costs, which has been the case for a bit. Food accounted for a good chunk of the rest. The 12-month increase was 2.4%, same as January. This would have been great. Normally, I would have said this is great. Each of these were the lowest annual change numbers since May, but because of the conflict in Iran, all of this stuff is absolutely meaningless. And this is not just me talking. Like if you go to any economist right now, they would say these inflation numbers are absolutely meaningless because the potential for disruption and already the upward pressure on pricing of this jump in oil prices is so massive. It's going to dwarf anything else that's going on here. So we just kind of have to wait and see where things are at. And then to add a little more context on that, economists, it's not an absolute science. So there's some disagreement, but just generally, like a number I've heard mentioned a fair amount, and this is kind of the range, but for every $10 increase in a barrel of oil, you will add 0.2% to inflation. And there's talk that if this gets prolonged, oil barrel prices will increase $100 above their pre-conflict number. That means that this has the potential to add 2% to inflation. If inflation is running at 2.4%, that's basically doubling it. And adding 2% to inflation, 2% is the Federal Reserve's goal. Like that's their goal, 2%. And we're talking about adding 2%. So very impactful. And then just because the numbers are meaningless doesn't mean I'm not going to also mention, in addition to being meaningless because there are all of these factors that are going to dwarf what is going on or what was going on when these numbers were reported, but also there's still a lot of guessing. Talk about this, but if anyone's new, so the Bureau of Labor Statistics, in order to come up with the CPI data, the inflation data, they have these enumerators that go out and check prices. Now, because of a hiring freeze, government shutdown, all of this stuff, they're short of enumerators. They don't have enough people to go out and check these prices. When they can't, and they physically manually check prices, like a pair of pants of this brand is this cost, or whatever, like specific things in specific places. When they don't have enough people to do that, or they can't find the thing, they either just take the cost of the same thing from somewhere else in the country that they already know the price of, and then they impute it and make an adjustment for that, or they find something that's kind of similar and they impute that, they make an adjustment for it. These are called it's called imputed cell imputation. It basically means educated guesses. Been talking about this for a bit. Historically, in our lifetimes, these guesses made up less than 10% of the data that comprised CPI, that comprised inflation numbers. For quite some time now, we have been over a third. And as you can see here, we're at 40% again. So it's, even if these inflation numbers were meaningful, almost half of them are guesses. So how accurate are they? I have serious doubts about that. Okay, going into the jobs market now. And you can see that we had a big loss in jobs. Lost 92,000 jobs in February. And that's kind of a big drop. It is most months, even as the job market was softening, we saw the gains decreasing, but there was only 2 other recent months here where we lost jobs. And excluding the skewed numbers from the federal government shutdown that you can see there in the 105, this is the largest number of jobs lost in a month since COVID. And now going back, like, I'm not going to tell you I told you so, but I kind of did tell you so. I've been talking for a while about how the jobs market is softening and healthcare has been propping it up. And here you have, so last month there was a big physician strike. And so instead of healthcare adding jobs, net addition of jobs, there was actually a net subtraction. And it's like, here you have just 1 month where healthcare isn't propping up the market, and you have a massive loss of jobs. So, like, and this is even going back to last year, 2025, we had a net addition of 185,000 jobs. So healthcare last year had a net addition of 400,000 jobs. So you take out healthcare, and we would have lost more than 200,000 jobs last year. And so just want to highlight that the employment market is very, very soft, softer than a lot of the data would tell you. And with this, like, if the conflict continues with the upward oil prices, it's going to soften the labor market even more, and we could start to see a lot more cracks. Unemployment rate was up 4.4%. And this is, I think, the last knock I'll make on what's happening with the data and all of this stuff. But the Bureau of Labor Statistics used to be a pretty kind of buttoned up, we just provide the data. Like, they just give the data, not a lot of color on it, not a lot of spin. But I want to quote from the release for this. They said that the unemployment rate changed a little at 4.4%. So it's like, what, they're putting spin on their economic data now to make it sound better. And the reason why that just struck me as very odd, because a tenth of a percent increase in unemployment is meaningful. So this 4.4% unemployment rate is tied for the second highest unemployment rate outside of COVID in the past 9 years. Second highest unemployment rate outside of COVID in 9 years. So it's meaningful. It's meaningful that we're at 4.4%. Still, in the history of the country, that's not too bad of a rate. But in recent history, it's kind of meaningful, indicative of the softening labor market. And so this is just something to keep an eye on. Like, we could see things changing. I used to say that the best thing that could happen to the District of Columbia real estate market would be a mild recession, because the majority of jobs in our area are recession proof, and a recession would cause a decrease in mortgage rates. If a recession comes from oil prices, that's not going to be the case, because we already have a softening of the labor market by a magnitude, like manyfold here, because of the loss of federal government jobs. Federal government used to provide a buffer against employment shocks. We don't have that as much anymore. And then also the reason why I said a recession would help is that with a recession, mortgage rates would come down, but with oil prices up, mortgage rates won't come down. So we could get the double whammy. We could have unemployment increase, the economy slow down, and mortgage rates increase, which would be bad for the domestic real estate market. Okay, what's going on with the Federal Reserve? I'm running behind, so I'm going to jump ahead. They just met yesterday and the day before. They held rates steady. That's what everyone expected. They also released their economic projections, which said, we think things are going to be pretty decent. Again, all this is moot. All this is moot because the specter of the conflict in Iran is so massive, it could change everything. If it goes away tomorrow, these projections are likely accurate. If it doesn't, you can throw these projections away because what happens won't be anything like this. 10-year Treasury, as of earlier yesterday, it was 4.2. It's probably a little bit higher. Now, retail sales down 0.2% in January after being flat in December, where there's usually robust holiday shopping. So what's really interesting is that so retail sales have been a little soft. They haven't been as soft as you would imagine because you have had retail sales kind of outstripping wages. So consumer spending has been increasing at a faster rate than income. So at some point, something has to give. Not surprisingly, U.S. credit card debt hit $1.28 trillion in Q4 of 2025. That's an all-time high. So, that's an all-time high. Like debt is increasing. People are becoming more leveraged. And so once we start to see the cracks starting to form, if things go downhill, they could go downhill in a hurry. Industrial production, both ticked up just a little bit, but manufacturing is still pretty soft. Okay, now let's find out what is happening in the DMV real estate market. How's the market? How are people feeling? And this is where please input all the information you have. If you have submitted any offers recently, let us know. Was it a multiple offer situation, a single offer? Were you able to get the property under list? Were you able to have contingencies? Were you competing? Did you have to put in clean offers above list, but fighting with multiple buyers? Same thing if you have listings. Or is it taking longer for your listings to sell? The data is saying it is, but I love to hear specific instances. Okay, now we start off with Northern Virginia, and thanks, Casey, for love to have you on here. We're going to cover that when we break into the county breakdown. The DC real estate market is incredibly soft, but there are still a lot of hot markets in the area and no inventory. So it's like you don't have to have a lot of demand when there's no supply. Okay, historical context. Now, we're only 2 months in as far as the data, so take this with a grain of salt. Last month, I said this projection was absolutely meaningless. Now it is mostly meaningless. Right now, we're on track for about 46,000 transactions for the year. At the end of the past couple of years, we've been right around 49,000, so we're behind that pace. Bright projects an increase in transactions this year, as do I. They're projecting 54,000. So we should see a boom and a really strong, like going into the spring throughout the rest of the year, things should be a lot more vibrant than they have been the last couple of years. Asterisk, unless the stuff with Iran goes really bad, and then that could keep things depressed and the market could be a lot slower than a lot of people think. Okay, if you've been following along to the data or following along me for quite some time, this shouldn't surprise you at all. We are now at the 33rd straight month of median sales price appreciation year over year in the DMV. Like, wow. It doesn't matter what's happening. Prices are still going up, not across the board, but DMV wide. 33 straight months of DMV price appreciation. Something else, though, it's like almost two things you can count on each month. You can count on prices going up, and you can count on homes taking longer to sell. Really interesting dynamics in this market. Median days on market are up to 22 days. That's double the days on market of last year. Like DMV wide, homes are taking twice as long to sell, but prices are still going up. And want to talk about things that are continuing. 20 straight months of year over year days on market increases. So this has been going on for a while. This is predated the current administration. Tom, I saw you chiming in. 50K over, no contingencies. Yeah. It's and that's the one thing. Like you can talk in generalizations, but there are micro markets in different areas. And like I just said, DC softest market in the area, but Tommy Kavanaugh is talking about they just ratified a listing 50K over with no contingencies. And so it's not, there's still, if you have a great listing that a lot of people will like, regardless of where it is, and if you're a great agent doing everything right, then your likelihood of success is a lot higher. Okay,
Yeah, I
now,
just
yep.
really quickly on that, I had a quick thought. Back in the 2008 like market crash, we still have multiple offers on some homes. So in any market, you'll still see multiple offers on homes. You'll still see above asking price, but in general, like yeah, because I still have that. Like I still see multiple offers and above asking price, but then I also see on average majority of homes, like majority of my listings are getting one offer or at the most two offers, and we're not going
Mhm.
above. With my buyers, I'm asking for I'm getting closing cost assistance. Like I expect that now. So like yeah.
Mhm. Mhm. Yeah, absolutely. I have a listing I'm in the process of preparing for market. Beautiful 3-bedroom, 3-bath property in North Bethesda. It was an investment property for a long time, tenants in it, so not in the greatest shape. If we listed it as is, I think it would probably sit for a while and we would get a relatively low price. We're probably going to do some updates. And if we do, I expect us to be under contract, hit the market on a Thursday, go under contract on Tuesday, multiple offers above list. And so, yeah, I mentioned this last week or last month, but it's what works for listings now. Well, it's what's always worked. You just create something that the largest group of people will like, price it appropriately, and do a great job marketing it, and you're probably going to have success. Okay, closed sales down 2.2% DMV wide, which is a little surprising. It's not as big of a swing as last month. Last month, there was an 11% decrease swing between the pendings of the previous month and the closed sales of the following month. Now it's only a 4% swing, but last month pendings were up by 2%. Closings are down by 2%. So roughly, just rough approximation, it's not exact, but rough approximation means that a little more contracts are falling out. So we are seeing an uptick in demand, though, as I would expect. You're seeing almost 4% increase in new pendings year over year. And that's meaningful. It's more meaningful than it would be otherwise. And I think these numbers would be even higher if not for the cold. I talked about this. January was very, very cold. End of January going into February, though, was still cold. We had 9 consecutive days where the temperature here didn't go above freezing. First time that's happened in like 35 years. But then we also had, I think I have it down here in my notes, first 13 days of February, we only saw 3 days above the 30s. And takeaway, never underestimate the effect of weather. It's kind of crazy. I've been doing this now, just really diving deep into the economy and the market for 4 years, like specifically into the economy more than I used to. And it never ceases to amaze me how much of a dramatic impact weather can have on so many different things related to the economy and the real estate market. So for what it's worth, I think these pendings would have been even higher if we had a normal February or a little bit of warm February. And I think that's why I think we're going to see a boom coming into the end of March and going into April. But as it's clear from the chart, you can see that these both closed sales and pendings are at the low bottom end of where they've been at for the last 5 years. Now, this is another interesting thing. New listings down by almost 13%. The actual amount of listings, we had this 3574. That is 33 more listings than January. Like that's kind of bonkers. Last year, we had a 10% jump in listings from January to February, and that's what you would expect. Seasonal stuff, like you start in January, and the engine just keeps revving up and getting hotter and hotter through the spring. Not so in this case, but I think this is also very much tied to the weather. Active listings also, active listings, same old, same old. We've now had 2 straight years of increases in inventory in the DMV. Last time we didn't have higher inventory in a given month than the year before was February of 2024. Like I said, well before the new administration or even the election. But we're closing the gap. We saw a lot of months where active listings were 30% over the prior year. Part of this is base effects, though, and you're going to start seeing this in a lot of inventory stuff. Inventory had already started increasing since we've had 20 straight months. Obviously, last year it had already started increasing. So the year over year change is going to be less because the number was already moving up. Okay, key metro stats is there in the deck if you want to take a look in more detail. Now we are hitting the county data. So as we discussed, DMV wide, we saw price appreciation. And breaking it down specifically, it's kind of what you would expect. You basically have Alexandria. Wow. So I try to go through the comments in an orderly fashion, but they pop up on my screen and then disappear. So I have to try to get them Get them while they're hot. Thanks, Casey, for sharing that. Yeah, and it's so true. It's like you can make generalizations. This just hits home even more about the market. But good stuff that appeals to a lot of people, turnkey, priced appropriately, it's going to go relatively quickly. 6 offers. So good work. Okay, so like I said, DMV, we saw price appreciation. Basically have Alexandria, Fairfax, Loudoun, and even Montgomery County close to even. Prince George's County and the District of Columbia, prices down. Those 2 markets I've been talking about for a bit are kind of the softest general buyer markets in the area. But what about Arlington, you say, Paul? What's going on in Arlington? Almost 8% drop in sales price year over year. So Arlington, Alexandria too, it's really interesting because you have such a mix of types of properties and condo. You have some $150,000 condos, and then you have some $3 million homes. And usually it's the breakdown of type of property that accounts for the difference. But I don't want to just speculate. And so I always like to dig a little deeper. And so here, let's just take a quick peek into Arlington. And you can see here in Arlington, so all home sales are down, but like I said, 7.9%. But then you look at the breakdown and detached prices were up, townhome prices were up, condo prices were up. That doesn't make any sense to me. But it gets even weirder. So they also have an attached all category. So you look and you're like, oh, that explains it. There is some other type of property, some other type of attached property that's not a condo and it's not a townhome that had a drop in price. And I've been dealing with this for years, literally. Like, this has been mystifying me when I see data that doesn't make sense, and I try to look a little closer to get the answer. And I see stuff like this repeatedly. And so I'm like, attached all, what else could be going on? Is that multifamily? So I looked up how many multifamily sales there have been in Arlington, and there just weren't enough to move the needle. But then I looked a little closer. Okay, so my math was always my best subject in high school, but maybe I'm rusty now. Maybe I'm a little rusty. Can someone else run the numbers for me? Does 81 plus 14 equal 95? It does, right? So we have 81 condo sales, 14 townhome sales. That equals 95. They're reporting 95 attached all home sales. So how is this possible? How is this possible? How can you have the 2 components of a number both have price appreciation and then the total be a price drop? Like, showing time, Bright, are you out there? Are you listening? Holler if you hear me. A little Tupac reference. Seriously, like, I've tried to get to the bottom of this. I'm going to keep digging deeper. I'm going to reach out to them again because I just do not understand what is going on with these statistics. This makes zero sense. If anyone can make sense of this, please let me know in the comments. Okay, so now going on to closed sales. Not much of a surprise here either. As I've said, generally DC and Prince George's County are a little weaker buyer market, so the drop in sales is to be expected. What was surprising to me, now I don't practice specifically in Frederick. It's just kind of too far. I've never sold a home in Frederick, but Frederick is booming. If we have anyone on here who practices in Frederick, let me know what you're seeing on the ground, because Frederick and Montgomery County were the 2 hardest hit counties by the federal government layoffs. They had the highest percentage of layoffs, federal government, in those 2 areas. But Frederick had the highest price appreciation of the core DMV last month by a fair amount. They had the biggest jump in closed sales. And we'll see in a minute, they also had the biggest gain in pendings. And we'll also see it was the only area in core DMV to have a year-over-year increase in new listings. So I'm not there personally, so I can't say what's happening on the ground. If I had to guess, I would guess it's because Frederick is the 2nd cheapest place in core DMV to live. And as you have people starting to get priced out of these areas, they have to move outward. Then when you have mortgage rates decreasing, you have people who are on the sidelines jumping back in. So where is this buyer demand going to go? Basically, the two lowest median sales prices for counties in the area are Frederick and Prince George's County. And then when you look at the kind of breakdown between the 2, Frederick has a much higher new construction. So basically, you can go to Frederick and get a new or almost new shiny townhome for kind of the same cost as an older home in Prince George's County. And then also if you're moving farther out, like you need more space. Why is that? Sometimes it's because you have kids and they have to go to school. And as a realtor, I can't talk about schools, but if you looked up school rankings of Frederick and Prince George's County, that might also tell you something that's explaining this. So that is that's my conclusion. Again, please, if somebody thinks I'm wrong, if there's another explanation for what's happening in Frederick, I would love to hear that. New pendings. Okay, new pendings are up a little overall, but not across the board. Down a little in Alexandria, almost even in Montgomery County, up 2 to 3% in Prince George's County and DC, up big in Arlington, Fairfax, and Frederick. So we're seeing some life. We're seeing some life in Prince George's County and in DC. So that's kind of nice. This is base effects again, though. Like their markets were already depressed this time last year. And so like overall, they're still softer markets than the other areas. It's just they were already there last year, but it's still good to see. It's good to see that demand is picking up from where it was. And then I just want to note the difference between Arlington and Alexandria might seem a little odd. Like Arlington is up by 13%, Alexandria is down by 2%. But these are such small markets that, like, literally, if Alexandria had a dozen more pendings, they'd have a massive gain too. So take that all with a grain of salt. Then there's Loudoun. So this is another outlier. And Loudoun weird things are always happening in Loudoun, which don't necessarily make sense to me until like I think about it and realize it's like, I think that's new construction driven again. Like annually, I think generally annually, Loudoun has the second highest number of residential new construction permits issued in the area. First is often Montgomery County. Second is often Loudoun. Montgomery County is more than twice the size of Loudoun, both in residential units and in population. And so as a percentage of housing stock, there's much more new construction happening in Loudoun. And so there are peculiarities as far as like when things are delivered and builders like trying to move inventory and all of that. And then also you have, so because of delivery dates, like in DC, in Prince George's County, in Arlington, I would say the majority of properties go under contract and then are sold, closed within 30 days. Not so in Loudoun. Like you might go under contract on a new development that won't be delivered for 6 months. And so you can see more of a disconnect in when a lot of those developments get delivered. Okay, new listings. We talked about new listings down everywhere except Frederick. Already talked about Frederick booming. Looked under the hood and saw, so 25% of right now, I looked up all active, coming soon, and under contract properties in Frederick, and 25% of those are new construction. So there's your answer. Like that's why they have more new listings than the rest of the area. Even though listings are down everywhere else, I expect this, along with other metrics, to rebound going into the spring. I think we are going to see a positive addition of listings for March and April and so on and so forth. Kind of continuing the trend we've been seeing, active listings are up pretty much everywhere except Loudoun and DC, which were also the two outliers last month. Just keep in mind, though, it's like, a 50% increase of nothing is nothing. And DC is the only area with meaningful inventory. And a lot of these areas still have lower inventory than we've seen historically. And one thing, occasionally I like to dig a little bit deeper. I talk a lot about 2019 inventory levels because for most parts of the DMV, 2019 was like the last normal year. It was before the artificially low mortgage rates came in with the pandemic. And then we had the spike and the golden handcuffs of people with these 2% rates in their homes who didn't want to move, which is really disrupted and hurt the market for quite some time. So 2019, last normal year before any of that hit. And so I just wanted to go back and take a closer look at 2019 inventory levels for all of these areas. And you can see that right now, even with increasing inventory, DMV Metro is less than 80% of the inventory levels of 2019. And outside of DC and Northern Virginia, every area in core DMV is still below their 2019 levels of inventory, and should go without saying that we've had a population increase since then. So, all things being equal, you should expect to see more inventory now than you did in 2019. What's interesting, if you look at Alexandria and Arlington, say, wow, almost double the inventory of 2019 in Alexandria, and 140% of 2019 in Arlington. And I'd kind of forgotten this because I didn't do a lot of business in Northern Virginia back then. I was really like corely focused on DC. But 2019 was a hot time in the Northern Virginia market. You had like it was the amount of contracts that ratified in February of 2019 in Arlington and Alexandria was like double the amount of the prior year. And then you also had only about 2/3 the amount of listings. So there's just like a crazy, crazy hot streak happening. And so that's why these numbers, if you go back to 2018 for, just to add some specificity to that, I have it down here. Where is it? They were both in 2019. Arlington and Alexandria were both under 1 month of inventory, just super super low. If you go back to 2018, though, the inventory levels are Arlington and Alexandria. They're still only at like 80 something percent of those inventory levels. Okay, moving on. Months of supply. Like I mentioned, outside of the District of Columbia, there is no meaningful supply anywhere in core DMV. Typically, people consider equilibrium to be 6 months or 5 to 7 months or 4 to 6 months, 4 to 7 months, where it's not a buyer's market or not a seller's market. DC is the only area that is not in a seller's market by definition of inventory. I know it's not feeling like that to a lot of you because you've been used to such extreme seller's market, but outside of DC, by definition, all of these areas are in extreme seller's market by inventory, and everywhere except Prince George's County is even under 2 months. I expect this to increase. You always have a seasonal bump as we go into the spring. Median days on market. So this is did I lose my moderator? Hope everything's okay, Temmie. This is kind of dramatic and meaningful. We talked about what's consistent. Prices going up is consistent, and days on market increasing is consistent. And not just consistent, though, but these are some dramatic numbers. And so I just know that some of these numbers are like so dramatic as to be unprecedented in most of our real estate careers. And I just want to give some specifics. I can only pull direct data on this for the past 10 years, but Prince George's County, 40 days on market, the highest days on market in at least 10 years. Frederick, talk about how Frederick is booming, and it is by every metric except days on market. Frederick at 30 days, this is the highest days on market in a little over 6 years. And then we have Montgomery County. It's the highest days on market in a little over 7 years. And now the pièce de résistance, the District of Columbia, 70 days on market, like almost double of what it was at last February. And so clearly this is the highest days on market in the District of Columbia in 10 years. I can't pull data, specific data, any more than 10 years, but I dug around a lot. And from what I can gather, this is the highest days on market in the District of Columbia since the subprime mortgage debacle and Great Recession of like 07 to 010. So if I had access to the specific data, I would expect you wouldn't see days on market in DC since like 2011 at the latest. So we're talking 15 years. And so this is super important. You talk about actionable intel that you get from these sessions, regardless of where you are. We've talked about some examples of stuff going under contract right away, multiple offers, and that still does happen. But it's really important if you are talking to seller clients, potential seller clients, if you're a listing agent, or if you are selling your home or considering selling your home, know that overall homes are taking longer to sell right now. So sometimes even if you do everything right, your home will take longer to sell than it would have otherwise. And it's just like the data is screaming this. I mean, obviously Fairfax and Loudoun, like it depends on where you are, a little bit of a different story. Stuff is going more quickly there, but in most of the reason you're seeing big jumps. Okay, showing level. Showings were up 3% DMV wide. Pendings were up 3.9%. So overall, that kind of tracks. Nothing earth-shaking here, but we are seeing some interesting disconnects. So like DC proper, showings were down 4.3%, but pendings were up 3%. I ascribe that to weather too. It's like if the weather's trash, if it's 30 degrees, your casual buyers aren't going to go out. Like you need to really like a house in order to go out and look at it in 30-degree weather. So like that kind of makes sense to me that the DC buyers, the ones who are out there, were a little more serious, but that doesn't hold for the rest of the area. So who knows? Okay, now we are going to take a closer look at the most recently reported weeks. So far, we have obviously mid-March. We have 2 reported weeks, week ending March 8th, week ending March 15th. So new pendings were up both weeks so far. And I think as the weather warms, we'll continue to see that bump. New listings, a bit of a mixed bag. So the first week, listings were up. You can see here, listings were up reasonably big. And then in the second week, they were down. And like I said, everything, like, I expect this to increase. I expect us to see a bump through the end of March into the rest of the year. I expect us to have more new listings this year than we did last year, but we'll wait to see. Showings, a little soft, down year over year for the first week, and then up just a little bit in the second week. Median days on market. You can see same thing we've been seeing. You're getting a seasonal decrease as you go from the winter into the spring. You'll see in absolute numbers each week days on market should decrease, but then you're also seeing a jump from last year's days on market by a significant margin, and that's pretty consistent. Active inventory, active listings, inventory up, but it's kind of similar to last month. So you have active listings up 12.5%, 11.5%. That's consistent with where we were at last year. Lower year over year jumps from where we have been, but base effects coming into play. Okay, over, but not by much. This is just wanted to include Bright forecast. We've covered this in more detail, but they are expecting a 7.8% increase in closed sales for 2026, ending the year with 54-ish thousand. Okay, key takeaways, super quick. Keep an eye on oil prices. The conflict in Iran could have a major impact on the economy, mortgage rates, and the real estate market. And following oil prices is the best way to track that. You can look at kind of the US barrel prices and then also the Brent international number. And following those oil prices will give you a great insight as to what's going to happen with the economy. District of Columbia real estate, District of Columbia proper real estate market is slow on both sides. Both listings and buyer demand is low. If you're a seller or listing agent, expect it to take longer to go under contract and know your market. A lot of variance from the different areas right now. Outside of DC and Prince George's County, it's a great time to sell in the new term, but mortgage rates could be affecting that. It's still not a bad time to sell in DC or Prince George's. Just your margin for error is a little smaller, and it's kind of important to put a little more time, a little more effort into those listings to have them succeed. Pretty good time to buy overall. If I have buyer clients, and I do, but what I'm telling them is, like, expect mortgage rates to increase as long as the conflict keeps going, and they could increase by a meaningful amount. So all things being equal, if you can get under contract and lock in a rate relatively soon, that is your best bet. All righty, 4 minutes over. We'll be wrapping up soon. If you have any questions or comments, reach out. If you like the content, hit like. If you're not subscribing to my channel, subscribe. All the usual things. And if you have any questions and want to just kind of reach out to me directly, there's all my info. Balanced inventory. So Maggie is asking if I think we'll realistically get back to balanced inventory levels or if this is the new normal. No, I don't think we'll get back to balanced inventory levels, only because we have constrained supply. In most of core DMV, there's not a lot of empty land to be building massive developments. And, they're like in DC, you have some office building conversions and things like that. But there is such a shortage of supply. And then not just here, but nationally, there's been such a shortage of supply. So if you look at, and I've shared this before, maybe I'll pull it up again next month. But if you look at new home starts, the amount of new construction being started in this country, it peaked in like 2007, and it's never recovered. So in 2007, even at the peak when there was the most residential construction, it wasn't meeting existing demand. And then it's plummeted since then. A lot of builders went out of business. So every year, housing supply is not meeting demand. So it's kind of hard to get back to a balanced market when you have that going on in general. And then you have an area where all of those problems are exacerbated because we have factors even beyond that limiting supply. So generally, I don't expect us to see a balanced market of supply and demand in any of the core areas for any prolonged period outside of system shocks in the next decade. But system shocks could do it. Like, that's what's happening in DC. You have a situation where for the first time in people's lives, they could work in DC and live in Ashburn. And for the price of a one-bedroom condo, they could have a four-bedroom house with a yard on a fake pond. So that has completely changed the game. So if there are new things that happen like that that completely change the dynamic, it's possible you could have supply and demand normalize. But in normal conditions, no, I don't expect that. Temmie the Great, thoughts, comments, closing remarks, anything you would like to add? By the way, for anybody who doesn't know Temmie, she's like a rock star. I mean, really, just like incredible agent and absolutely one of the top agents at Fulcrum, one of the top agents in the area. So I always I'm the one just talking nonstop. It's just drivel coming out of my mouth in these sessions. But anything that Temmie says, pay close attention because I guarantee you she is getting more reps on the ground than most people on this session.
I would just say, like, if you were freaking out like me a few weeks ago about the whole Iran conflict and everything like that, and just everything that's going on in the economy, I'd say, no matter what the market is, people are still buying and selling real estate. I always go back to the 2008 market crash. Like, that was really rough. That was really rough. And I lived in a county that was #1 in short sales and foreclosures. We beat out Baltimore City and Baltimore County. So no matter what is going on in the market, remember who you are as a real estate agent and your job to serve your community and make
Mhm,
sure that you just focus on that, serving your community. There are still people out there that need to buy for whatever reason, need to sell. I'm doing more short sales this year
mhm,
for people who are having turnover because they purchased like a year or two ago. So, make sure that you are still, just focused on serving your community.
mhm. I love that, Temmie, and I'm so glad you mentioned that because usually I'll throw in a little blurb on that when I talk about projection for the year, and I didn't this time. But right now we're on pace for 46,000 units sold, which I think would be the fewest units sold in the area since 2008 or 2007. But that's still 46,000 homes sold. That's still more than enough for everyone on this session, anyone watching who's an agent, to have the best year of their career. So going into, we had in 2024, 2025, we had, the market obviously slowed down, and I double and tripled my business personally by just taking a more concentrated approach and going to where the market was. Now I have a small kid. That's not happening any longer, but it is absolutely possible. And then what's even more important from what Temmie said, in my opinion, is serve your communities. I love the Go Giver shared to me by Tommy Cavanaugh back when I joined Fulcrum and Keller Williams Capital Properties like 8 years ago, one of the first books he gave me. And they talk about enlightened self interest. If you put others' needs ahead of your own, you'll always be taken care of. So, if you're looking out for others and you'll end up okay, why not come from that approach? And as real estate agents, we provide a lot of very useful and essential information, particularly now in a time of transition. So it's absolutely love that you shared that, Temmie, and keep up the good work. Wonderful having you on here as always. Appreciate you all who have joined us. If you're watching this on the video later and have any comments, just drop them in the comments. I pay attention to those and respond and actually adapt my sessions. Like, I've changed and modified and added some new data that I present from feedback I've gotten there. So have a wonderful rest of your day and rest of your spring, y'all. Tomorrow, 66 degrees, 70s over the weekend. Good time to be in real estate. Good time to be alive. Thanks, everybody.